More than 1 in 5 Canadian households are already struggling to pay their mortgage, and experts warn that 2026 could bring the largest housing disaster in Canadian history. Imagine millions of families facing the terrifying possibility of losing their homes, not because of poor choices, but because the entire system is cracking under pressure. Interest rates are climbing, debt is exploding, and housing prices are more unstable than ever. Behind the headlines, a storm is building that could turn the Canadian dream of homeownership into a national nightmare. What's driving this collapse, and why could it all come crashing down next year? Here are the 10 shocking reasons that could force millions out of their homes. Number 10. Global economic shocks. The final factor that could ignite Canada's 2026 housing disaster is the threat of global economic shocks. Canada's housing market does not exist in isolation. It is deeply tied to the global financial system. A downturn in the United States, instability in China's property sector, or surging oil prices could send ripple effects that hit Canadian families hard. For instance, if the U.S. enters a major recession, Canadian exports would decline, jobs could be lost, and consumer confidence would plummet. When people fear for their financial future, housing markets react quickly, with fewer buyers entering and more sellers trying to escape before prices fall. Another danger is tied to global interest rate policies and currency fluctuations. If central banks around the world continue tightening monetary policy, borrowing costs could rise even higher in Canada, making mortgages even less affordable than they already are. At the same time, if the Canadian dollar weakens, imported goods, from construction materials to everyday essentials, become more expensive, squeezing families further. These global shocks act like invisible forces pressing down on Canadian households, making it impossible to plan for stability. Even those who have been financially cautious may find themselves trapped in a crisis sparked not at home but abroad. Perhaps the most worrying part of global shocks is how unpredictable they are. No one could have predicted how a global pandemic would send Canadian housing prices soaring, just as few can predict which crisis might strike in 2026. It could be geopolitical tensions, another banking collapse, or even climate-related disasters that disrupt markets worldwide. What is clear is that Canada's housing market is fragile, and any external shock could push it over the edge. If such an event aligns with the existing pressures of debt, interest rates, and construction slowdowns, the result would not just be a local downturn but a nationwide housing disaster with millions of families caught in the fallout. Number 9. Government policy missteps. One of the most underestimated drivers of Canada's looming 2026 housing disaster is a series of government policy missteps. Over the last decade, policies have often been reactive instead of proactive, introduced in response to political pressure rather than long-term strategy. Measures like foreign buyer taxes, vacancy taxes, and stricter mortgage stress tests were designed to cool the market, but many had unintended consequences. Instead of creating affordability, they often reduced buyer confidence while failing to address the core issue, the severe lack of supply. As a result, families still cannot find affordable homes, while those already in the market are crushed under higher costs and tighter rules. Another policy failure lies in the overpromising of housing targets that rarely materialize. Federal and provincial governments have announced ambitious goals of building hundreds of thousands of homes, yet construction data consistently falls short. Municipal red tape, zoning restrictions, and slow approval processes further delay new developments, making it nearly impossible to meet rising demand. At the same time, subsidies and tax incentives aimed at helping buyers sometimes backfire by inflating demand even more, pushing prices higher instead of stabilizing them. These policy contradictions create confusion and frustration, leaving Canadians skeptical about whether their leaders truly understand the scale of the crisis. Looking ahead to 2026, the danger is that poorly timed or poorly designed policies could actually accelerate the collapse. For example, if new mortgage rules tighten credit further, many buyers will be locked out, reducing demand abruptly and causing prices to fall. If property taxes or development levies rise too quickly, builders may cancel projects, worsening supply shortages. And if immigration levels continue without parallel housing expansion, demand will overwhelm the system entirely. Government missteps often turn manageable problems into disasters, and unless leaders coordinate with economists, developers, and local communities, the wrong decisions in the next year could be the tipping point. In this sense, policy failure is not just a background issue, it could be one of the central triggers of Canada's housing crisis in 2026. Number 8. Foreign investment retreat. Another force that could accelerate Canada's 2026 housing disaster is the retreat of foreign investment from the real estate market. For years, wealthy investors from around the globe poured money into Canadian cities, treating properties not only as homes but as safe assets. Cities like Vancouver and Toronto became magnets for offshore buyers, driving demand and inflating prices beyond what local residents could afford. While this surge created wealth for developers and homeowners in the short term, it also built a market dangerously dependent on the flow of international capital. If that capital dries up, the shockwaves could destabilize the entire housing system. Signs of this retreat are already visible. Stricter government regulations, such as taxes on foreign ownership and vacant homes, combined with global economic uncertainty, are discouraging investors. At the same time, other countries are becoming more attractive, drawing away the very buyers who once fueled Canada's real estate boom. As foreign investors pull back, luxury condos and high-priced properties may sit unsold, causing developers to cut prices. This domino effect can ripple downward into mid-range and even entry-level housing, dragging the whole market into decline. Homeowners who bought at inflated values may suddenly find their properties worth far less, trapping them in negative equity and financial distress. The bigger risk lies in how interconnected foreign investment is with broader confidence in Canada's housing sector. If the global perception shifts from Canada being a stable, profitable housing market to one facing collapse, domestic buyers may also lose trust, accelerating the downturn. Developers relying on foreign pre-sales to finance construction could be forced to abandon projects, adding to the already severe supply shortage. Meanwhile, financial institutions exposed to risky loans tied to investor-driven properties may tighten lending, making mortgages harder for average Canadians to access. The retreat of foreign investment may seem like a distant concern, but in reality, it could be a key trigger that transforms a shaky market into a full-scale housing disaster in 2026. Number 7. Construction slowdowns. A less visible but equally dangerous factor in Canada's looming 2026 housing disaster is the severe slowdown in construction. For years, policymakers have promised that increasing housing supply would ease the affordability crisis, but in reality, new builds have struggled to keep up with surging demand. Rising material costs, persistent labor shortages, and global supply chain disruptions have driven construction timelines far beyond expectations. Projects that once took 2 years are now stretching into 4 or more, leaving buyers and renters waiting while housing shortages grow worse. With population levels climbing rapidly, every delay in building widens the gap between supply and demand, creating the perfect storm for a nationwide crisis. Developers are also facing financial pressures that make them hesitant to launch new projects. Higher interest rates mean borrowing to fund construction has become extremely expensive, while unpredictable market conditions raise fears that completed units may not sell at the prices once expected. Some developers are canceling projects outright, while others are shelving them until conditions improve. This hesitation compounds the crisis because the pipeline of future housing shrinks, ensuring that shortages will persist well into 2026 and beyond. Even ambitious government targets for new housing units are falling far short, leaving Canadians skeptical about whether promises to fix the housing crisis are anything more than empty slogans. The impact of construction slowdowns is felt across the entire housing system. When fewer homes are built, both ownership and rental markets tighten, driving prices and rents even higher. Families hoping for relief through new developments are instead left with fewer options, often forced to compete in already overcrowded markets. This intensifies frustration, fuels bidding wars, and deepens the affordability crisis. If Canada cannot overcome the barriers stalling construction, the shortage of new housing will act as a choke point in 2026, magnifying every other issue: rising debt, rental collapse, and interest rate shocks. Without a significant acceleration in building, the slowdown will not only worsen the disaster but also delay recovery, leaving millions struggling to find stable housing in the years ahead. Number 6. Rental market collapse. Another major driver of Canada's potential 2026 housing disaster is the looming rental market collapse. Over the last several years, rental prices have climbed to historic highs, forcing millions of Canadians into financial strain. In cities like Toronto, Vancouver, and Calgary, rents have risen so quickly that families are spending half their income, or more, just to keep a roof overhead. For younger generations, international students, and low-income households, renting has become a near impossible burden. The crisis deepens when you realize that as rents soar, many renters are unable to save for a down payment, effectively trapping them in an endless cycle where the dream of ownership remains out of reach. The collapse risk grows because this unsustainable rental environment creates a fragile system built on desperation. Landlords, facing higher mortgage payments themselves due to interest rate hikes, often pass these costs directly onto tenants. This sparks bidding wars for basic apartments, where people are forced to pay far above asking just to secure a place to live. When tenants cannot keep up, eviction rates rise, leading to overcrowding, homelessness, and severe social stress. The rental sector, instead of acting as a stable alternative to ownership, has become a pressure cooker where affordability and availability are nearly non-existent. If this system breaks down further in 2026, it could unleash a wave of instability unlike anything Canada has experienced in decades. The danger is that a collapsing rental market doesn't only hurt renters, it spills over into the entire housing ecosystem. When renters are priced out, fewer can transition to buying, which reduces overall demand and triggers falling home values. At the same time, landlords unable to fill units at inflated rates may default on their loans, further destabilizing the market. These chain reactions make the rental crisis a central piece of the larger housing disaster narrative. Unless bold reforms and expanded housing supply address the imbalance, the rental market collapse could push millions into crisis, turning housing from a source of stability into one of Canada's deepest vulnerabilities in 2026. Number 5. Immigration and population pressure. One of the most talked about forces fueling Canada's 2026 housing disaster is the immense pressure created by immigration and rapid population growth. Canada has welcomed record numbers of newcomers, including skilled workers, international students, and refugees, as part of its strategy to strengthen the labor market and address demographic challenges. While immigration brings cultural diversity and economic benefits, the sudden surge in demand for housing has pushed the market to breaking point. Simply put, there are far more people searching for homes than there are properties available. This imbalance drives prices up, making both renting and buying increasingly out of reach for average families. The challenge is not immigration itself but the lack of preparation in infrastructure and housing supply to accommodate this growth. Major cities like Toronto, Vancouver, and Montreal have absorbed the majority of newcomers, creating intense competition for limited housing stock. As landlords and sellers realize they can charge more due to high demand, rental bidding wars and skyrocketing property prices have become the norm. For immigrants, this often means living in overcrowded conditions or being forced into neighborhoods far from job opportunities. For existing residents, it leads to frustration and resentment as affordability continues to collapse. When policies fail to balance population growth with supply, the result is a fragile system that risks crumbling under pressure. Looking ahead to 2026, experts warn that if immigration levels remain historically high while construction and housing policy fail to keep pace, the crisis could escalate dramatically. Families may find themselves unable to secure stable housing, while vulnerable groups such as students, refugees, and low-income workers are pushed into precarious living situations. The social fabric of Canada could also face strain, as divisions deepen between those who can secure housing and those left struggling on the sidelines. Unless policymakers find innovative ways to expand supply and improve affordability, the combined forces of immigration and population pressure could act as a powerful trigger that accelerates the looming housing disaster, leaving millions at risk of losing stability in the place they call home. Number 4. Wage growth not matching inflation. Another powerful driver behind Canada's potential 2026 housing disaster is the painful reality that wage growth has failed to keep pace with inflation. Over the past decade, the cost of living has surged in nearly every category: food, transportation, energy bills, and especially housing. Yet, when you look at average salaries, the numbers tell a different story. Income growth has been sluggish, leaving families with less real purchasing power year after year. This widening gap creates a dangerous imbalance. Even households working multiple jobs are finding it nearly impossible to cover mortgage payments or rent, leading to stress, financial strain, and in many cases, the risk of losing their homes altogether. This issue becomes even more severe when combined with rising interest rates and record household debt. A family may have been able to afford a modest mortgage 5 years ago, but with wages stagnating, those same payments now consume an overwhelming portion of their income. Economists often use the term housing cost burden to describe when more than 30% of income goes to housing, but in Canada, many families are now spending 40 to 50% of their income just to keep a roof over their heads. That leaves almost nothing for emergencies, savings, or even basic needs. When wages cannot keep up, households are forced into credit dependency, which further worsens financial vulnerability and creates a cycle that is hard to escape. The emotional toll of this gap is just as concerning as the financial one. Families feel like they are running on a treadmill, working harder but never moving forward, while homeownership drifts further out of reach. This sense of hopelessness erodes trust in the market and in government policies that promise relief but rarely deliver. If wages continue to lag while inflation and housing costs accelerate, millions of Canadians will be at risk of being priced out of their homes, creating a crisis that touches every corner of society. Without immediate and meaningful change, the mismatch between income and costs could become one of the most devastating forces behind the housing collapse in 2026. Number 3. Housing bubble bursting. One of the most alarming signs of a potential 2026 housing disaster is the looming risk of a full-blown housing bubble bursting. For years, Canadians have watched property values climb at breakneck speed, often far outpacing income growth and basic affordability measures. Cities like Toronto, Vancouver, and Ottawa saw home prices soar to levels that even seasoned investors described as unsustainable. Many first-time buyers rushed into the market, afraid they would be permanently priced out, while investors piled in hoping for quick profits. This frenzy created an overheated environment where housing was no longer simply about shelter but about speculation, and speculation almost always ends with painful corrections. The danger lies in the simple economic truth: what goes up too fast eventually comes down. When homes are selling for hundreds of thousands above asking, supported by bidding wars and emotional decision-making, the market becomes detached from reality. Analysts warn that if prices fall sharply in 2026, families who bought at peak prices could see their equity evaporate overnight. Negative equity means homeowners owe more on their mortgages than their properties are worth, creating financial traps that leave families with no way out. At the same time, banks and lenders face rising risks, as defaults on loans become more common, potentially shaking confidence in the broader financial system. This bursting bubble does not just impact homeowners but ripples through the entire Canadian economy. Construction slows as developers pull back, real estate agents see fewer sales, and consumer spending shrinks because families feel less wealthy. With housing representing a massive share of Canada's GDP, even a moderate correction could cause widespread economic pain. For ordinary people, the risk is deeply personal: losing their home, draining their savings, or facing the terrifying possibility of starting over in a market that has collapsed. If the bubble truly bursts in 2026, it will not only mark the end of an era of explosive growth but also signal the beginning of a nationwide housing crisis that reshapes Canada's economic landscape. Number 2. Record household debt. Another critical factor pushing Canada closer to a 2026 housing disaster is the overwhelming level of household debt. Canadians now carry some of the highest debt loads in the entire world, and much of it is tied directly to housing. Families stretched themselves thin during the years of cheap borrowing, taking on massive mortgages under the belief that interest rates would stay low forever. Add to that rising balances on credit cards, auto loans, and personal lines of credit, and the average household is now burdened with payments that eat away at every paycheck. This leaves very little room to breathe financially, and when even a minor crisis hits, families are pushed to the edge of collapse. What makes this situation so alarming is the combination of stagnant wages and relentless inflation. While the cost of living has climbed sharply, most Canadians haven't seen their income rise at anywhere near the same pace. That means families are borrowing just to stay afloat, digging themselves deeper into a financial hole every single month. Statistics already show that a large share of households are spending more than 30 to 40% of their income on housing costs alone, a level many economists consider completely unsustainable. Once you factor in debt payments for other essentials like education loans or medical expenses, it becomes clear why experts are warning of a looming debt crisis that could ignite a wave of bankruptcies. The frightening reality is that debt acts like a chain holding back financial stability. For many Canadians, the dream of homeownership turned into a nightmare of endless payments with no relief in sight. If housing prices decline while debt levels remain at record highs, families could face a double hit, losing equity in their homes while still being crushed by their obligations. This toxic cycle puts millions at risk of losing everything they've worked for. Without meaningful solutions, record household debt could become one of the most destructive forces behind Canada's 2026 housing disaster, dismantling financial security for families across the country. Number 1. Skyrocketing interest rates. The first major factor driving Canada toward a potential 2026 housing disaster is the relentless surge in interest rates. Over the past few years, the Bank of Canada has been aggressively raising rates to combat inflation, but the ripple effect on the housing market has been devastating. What once felt like manageable monthly mortgage payments have now doubled for some households, pushing thousands of families into financial distress. Imagine a young couple who purchased a modest townhouse during the low-rate era. Today, their payments have become so overwhelming that they are being forced to choose between paying their mortgage or covering essential expenses like groceries and utilities. This pressure is building across the nation, and the fear of widespread foreclosures is becoming a serious concern. Adding to the crisis is the fact that most Canadian homeowners are tied to variable-rate mortgages or are facing renewal at dramatically higher rates. Unlike fixed long-term systems seen in other countries, Canadian borrowers often lock in for short terms, making them more vulnerable to sudden rate hikes. Financial experts are warning that 2026 could see a massive wave of defaults as people simply cannot keep up. To make matters worse, the housing affordability crisis is colliding with rising consumer debt, creating a dangerous cocktail that threatens the stability of the entire system. Even those who bought responsibly under previous conditions are now at risk, highlighting how quickly the ground can shift in a volatile market. The reality is stark. As borrowing costs climb higher, the dream of homeownership is slipping away for millions. Properties that once represented security are transforming into unbearable financial burdens. The housing market thrives on confidence, but confidence shatters when families feel trapped with no way out. If interest rates continue their upward trajectory, we may witness not just isolated cases of financial hardship, but a full-blown national housing disaster that shakes the core of Canadian society. Canada's housing market stands on the edge of an unprecedented 2026 disaster, shaped by a perfect storm of forces. From skyrocketing interest rates to record household debt, from the risk of a housing bubble bursting to wage growth failing to keep pace with inflation, every piece of the puzzle points toward instability. Add in mounting immigration pressure, a collapsing rental market, crippling construction slowdowns, the retreat of foreign investment, repeated policy missteps, and unpredictable global economic shocks, and the picture becomes even more alarming. This isn't just about numbers on a chart, it's about families who may lose the homes they've built their lives around, about communities that could face mass displacement, and about a national economy that risks being shaken to its core. While some still hope for recovery, the warnings are too serious to ignore. By understanding these 10 reasons, Canadians can prepare themselves for what may be one of the most difficult years in the history of the country's housing market. The story of 2026 will not be written by chance, it will be shaped by these forces already in motion. What do you think? Are we heading toward the biggest housing collapse in Canadian history, or can it still be stopped? Share your thoughts below, we read every single one. And if you want to dive deeper, check out our previous video on Canada's debt crisis. It connects directly to this story. We put countless hours into researching and producing these videos, so please support us by subscribing. It's just one click, but it means the world to us.